I've been a financial money manager for 30 years, and there was one axiom that I learned is if you're younger, you could take more risk, and if you're older, you need to take less risk. Makes sense to me. You get older, you're in retirement, you can't afford to lose 50, 60% in a bear market. But if you're younger, you can afford to do that. So just be aggressive. Let's talk about that principle. I want to look at investing very aggressively, let's say in the NASDAQ, very, very aggressive. In fact, the risk on the NASDAQ has a risk factor of 73%. That has to do with max drawdown and whatnot. But the point being is, what if I can get less return but more safety? Is that a better way to go than being young and taking more risk? So what I did was I put together a chart of investing in the NASDAQ, the S&P, diversified 60-40 annuity, as opposed to investing in our structured products, which are hedged, which protect your downside but don't give you as much upside. So what we did was we said, what if we can get 75% of the S&P but no downside risk? Will we do better over, let's say, a 23-year period from 2000 to 2023? Let's take a look at the chart, and we can see obviously that if I only get 75% of the upside, but I am protected on the downside in bear markets like 2022, it's the axiom, the hare and the tortoise. As Warren Buffett said, the secret to investing is not necessarily winning, it's not losing. And if we use this concept, you have a situation where you blow out the NASDAQ, 9.25 as opposed to 7.29, the S&P at 703, diversified 60-40, 6.23, and of course, an annuity is not worth talking about. So the concept here is simple. If we can get less return but cut off our downside risk, we're actually going to be better off in the end. So here's my question. If you're 30 or 40 years old and say, well, I'm just going to be in the Mag 7 or I'm going to be in the NASDAQ and just try to win the race and not worry about the bear markets, the evidence does not support your conclusion. Does this make sense?